More federal aid is on the way, and there will be more to come as the coronavirus crisis continues. Do you know how to take full advantage of the government's efforts to help your retirement plan? It's that time again, time to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. Over the last few weeks, we've talked a lot about the government's response to the economic impacts of the coronavirus crisis. So far, it's included a wide range of moves by the Federal Reserve, the $2 trillion Congressional CARES Act, and another relief bill totaling nearly $500 billion. Today, we're going to take a closer look at how the CARES Act might impact your retirement plan and the opportunities that actually provide specifically to help people who are in or nearing retirement. The income generation. Could some of these opportunities make sense for you? Does the CARES Act mean you should rethink your strategy around RMDs, required minimum distributions, or around Social Security or even charitable giving? Does taking a loan from your IRA make sense now? We'll examine these questions and many others on today's show, and joining us again this week will be my co-host, Jeff Small, along with our special guest, author, speaker, television host, and IRA specialist, Ed Slott. And once again, we're giving you the opportunity to join the conversation. At any point, you could submit your own questions or comments via phone message, text, or email, and we'll respond to your input later in the show. But before we talk to Jeff, let's review how the CARES Act actually impacts RMDs. As we've discussed on previous shows, the coronavirus relief bill, the CARES Act, approved by Congress, includes a provision that suspends required minimum distributions this year, 2020. The idea is to help older Americans endure this crisis by giving them a break on the taxes they would otherwise have to pay on their RMDs, and by not forcing them to pull money from their IRAs in the midst of so much market volatility. Doing so can be extremely risky for retirees who haven't taken steps to ensure their asset allocation is right for RMDs, as we talked about just last week right here on the show. Now, while the CARES Act temporarily eases that risk for 2020, it doesn't reduce it long term. In my experience, that's something that you can only do once you've shifted your strategic focus from portfolio growth to portfolio income. And of course, we'll talk more about that and what the CARES Act means for RMDs in a few minutes with our guest, Ed Slott. But first, let's briefly touch on another provision in the relief bill that's aimed at retirement accounts, and that is a coronavirus-related distribution exception for 2020. With this provision, IRA holders who are adversely affected by the coronavirus pandemic are eligible to take tax-favored distributions of up to $100,000 from their retirement accounts. You can recontribute the coronavirus-related distribution money back into your IRA within 3 years of the withdrawal date, and therefore treat both the withdrawal and the recontribution as a totally tax-free transaction. There are no limitations on what you can use the funds for during the 3-year period. But what if you don't recontribute to the coronavirus-related distribution back into your IRA? Well, you do have that option, but if you don't put the money back in, you'll be taxed on the distribution amount that you don't recontribute within the 3-year window. Now, here's the good news. If you're under 59.5, you don't have to worry about the well-known 10% penalty for early withdrawal, even if you don't make this recontribution. According to the CARES Act guidelines, there are a number of scenarios in which you might qualify for the exemption. They include being diagnosed with COVID-19 or having a spouse or dependent who's been diagnosed. It includes being furloughed or laid off from work, or being unable to work due to lack of child care during the quarantine. Here's the general idea. During this crisis, the option to borrow from your retirement accounts with no tax penalty, or to withdraw from them with a reduced tax burden and being able to pay those taxes over 3 years may prove extremely helpful for some people. We'll talk about other provisions in the CARES Act geared toward retirement plans later in the show. Now let's bring in my co-host, Jeff Small, to talk more about this. Jeff, I don't even know where to start with some of the news that came out this week between another unemployment report, the GDP report, corporate earnings. Where do you want to start? What's most important, do you think, for our income generation members to really get a grasp on this week's news?
Well, the news was bad this week. We've got 30 million unemployed jobs, and we talk about unemployment every week, but that doesn't seem to be impacting the forward-looking aspects of valuations in the markets. And the markets are coming back. As we talked about in the prior shows, we don't see a lot of downturn going forward unless the news gets really bad or the virus resurges. And so I think the best thing for now for consumers, viewers, listeners of ours, and the income generation is to be very careful, be vigilant, because the market will trade on headline news. And we've had some great headlines this week, Dave.
Yeah, it really is headline news, and it's kind of funny because the markets have stayed calm, and we've had some very positive news with the virus, but we've also had some negative news financially. I mean, GDP growth shrank by 5% in the first quarter, and that's bad enough on a standalone basis. But what makes it worse is the fact that really it was only the last couple weeks of the month where we've had economic slowdown when people end up being quarantined. So really it's only 2 of the 13 weeks in question, but even that was enough to have a really result in a minus 5%. I mean, what's second quarter going to look like? That's the real question.
Well, we know that second quarter is going to be dreadful. But as the economy continues to open up, and they just opened up Florida, 25% of Florida is now officially opening up. As the rest of the country opens up, that will spring back with pent-up demand into the fall, even though we're not going to quite be where we were prior to, let's say, January 1st in terms of consumer demand in general.
Yeah. Well, you opened up. Your part of Florida opened up. My part of Florida, Broward County, Palm Beach, and Miami-Dade is we're still under lock and key for a while. We'll have to see what happens. But I think even like the rest of the state opening up, they're talking about 25% capacity in restaurants. And I don't know, I'm not a restaurant guy or restaurant analyst, but the question is, can restaurants even make money at 24 or 25% capacity? Or, for example, how are the airlines making money? It seems to me today as a pilot, when I know how much things cost, that you fly an airplane around that's 3/4 empty, and I've got to think it's just as bad, and I know that's economically a loser for these companies, so I would think it's just as bad as having a restaurant 75% empty, wouldn't you?
Yeah, it really doesn't solve the problem. I think ultimately, though, if we're going to have this very staggered approach to opening up the economy, travel, tourism, hospitality, restaurants, servicing, all that stuff, all the services, we have to get more back into what we call a Sweden model, because they really stayed open and allowed their citizens to practice social distancing, and they have the same numbers in terms of the virus declining and the rate of infection declining. So that's really where we need to get to, Dave.
You and I differ philosophically with that, because I always feel like, if you've ever met Swedish folks, they're very, in some ways it's like the German culture. They're very, very disciplined, very rigid. And I mean that in a good way. I mean that only in a complimentary way, especially in a situation like this. And in the United States, we tend to be a little bit more freewheeling. We believe in entrepreneurship, and certainly we love our freedoms and our rights. And as a result, I don't know if in the real world what worked in Sweden can work here. So that's why my concern is that we go back, we open up, and next thing you know, we have a whole other wave of infections. And next thing you know, we're back under lock and key again. I mean, I hope that doesn't happen. I hope, everybody wants to be right when they make predictions. But Jeff, believe me when I tell you that in this particular situation, I really hope that prediction is wrong, because I don't want to be right when it comes to that.
Yeah, I agree with you. I don't want you to be right either. So I think though, we just don't have the data, and we have lots of medical experts prognosticating about what the potential could be, and lots of financial guys prognosticating about what's going to happen going forward with the markets and the economy. But we're kind of in the dark here, and we really don't know until this thing actually materializes. So you have to be vigilant with your money at this stage. Even though we've had a recovery, you've got to be vigilant, Dave.
Yeah. Well, and is one great thing to do is when the government comes out with certain tax breaks and things that allow you essentially to get free money, you want to be aware, you want to take advantage of it. That's an easy thing in any market. And since those are out there now with the CARES Act and so on, one of the things that I can't wait to do in just a few minutes is ask our guest Ed Slott what he thinks are the major features to take advantage of there. Because you and I, throughout the rest of the show, will continue to talk to you, our income generation viewers and listeners, about the things that you can do financially in your portfolios to really take advantage of this, to take this time and really make it opportunistic, a positive instead of a negative. But Jeff, I can't wait to see what Ed Slott says on the tax end, some of the big advantages to this last tax act.
Yeah, Ed's really a hoot. He's like the national spokesperson for IRAs and profit-sharing plans and retirement plans. He's a CPA, has no real allegiances to anybody, but he is considered the foremost authority on how consumers can access their retirement plans through IRAs and what we should be doing going forward as a result of the CARES Act. So I'm just as excited, Dave, as you are.
Yeah. There's one thing I want to talk about. He'll probably steal my thunder and beat me to it, but I want to talk about something with you and our viewers and our listeners about Roth IRA conversions and some advantages that you have there when markets drop. But this last market drop was so quick and so violent, and then it recovered so quickly that in order to take advantage of that from a tax perspective, you'd have had to act so quickly it would have been virtually impossible. So, we'll see if we get another downturn in the markets that's a little longer lasting. Maybe it's a positive because maybe people can take advantage of some of these Roth conversions and the like. So, we need to take a commercial break. Stay with us. We have more coming up right here in just a moment on the income generation. I'm David Scranton. I'm with Jeff Small, and we'll be right back. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
In addition to the provisions we've discussed around RMDs and emergency distributions, the CARES Act also includes temporary changes affecting 401ks, Social Security, and charitable contributions. Many 401ks and similar plans currently allow participants to take out a plan loan of up to $50,000 or half the vested account balance. Loans are then repaid over a 5-year period through payroll deductions. However, the CARES Act makes two big changes to this rule. First, participants can now borrow up to $100,000 or all of their vested account balance, whichever is less. The second change is you now have an extra year to pay back that loan. As always, the devil is in the details, of course, with these rules, so it's obviously best to discuss them with the help of the right financial advisor. Now, regarding Social Security, the CARES Act allows self-employed individuals to push off the employer liability side of FICA taxes that are owed on employee wages from March 27th through the end of the year. Now, while this change affects relatively few people in the short term, it could have long-term consequences for everyone due to its potential impact on the Social Security Trust Fund. In fact, the coronavirus crisis as a whole has the potential to put more pressure on this trust fund, which is already on track, if no future changes occur, to be out of money by the year 2034. After that, it would only be able to pay about 78% of promised Social Security benefits. The current crisis may also mean that your individual Social Security strategy needs to change in order for you to maximize your benefits and to make sure that you've properly coordinated your benefit choice with your other sources of retirement income. Finally, the CARES Act also includes 3 major changes around qualified charitable distributions, known as QCDs, which are a popular strategy for satisfying required minimum distributions among many retirees. It's time to bring back our co-host, Jeff Small. And also, we want to welcome back to the show, good friend of the income generation, Ed Slott. Ed's an author, speaker, and television host. He's been called the best source for IRA advice by the Wall Street Journal and America's IRA expert by Mutual Funds magazine. Ed, thanks so much for being back with us right here on the show.
Great to be here. Every time I come back, new information, new tax rules, everything's changed. People are so confused, including financial advisors.
Yeah, it's true. It's true. But it's quite simple, right? I mean, all we need to know is nobody has to take required minimum distributions for 2020. I mean, there's nothing else that we need to know, right? That's it. It's that simple,
well,
right?
That's it in a nutshell. So thanks. That was a good segment. The questions I'm getting is, who does it apply to? And as you said, it's pretty much everyone that had a required minimum distribution due in 2020. Now, some of the confusion is some people had a 2019 RMD, required minimum distribution, due by April 1st, 2020. If they didn't take any of that in 2019, then they would have had to take it in 2020 by April 1st. That 2019 distribution not taken in 2019 is waived. Those people get a double benefit, because if they didn't take it in 2019, then they would have to take their first 2 distributions in 2020, and those are both waived. So that's one question. Another common question we're getting, and this is probably one of the biggest ones, and I don't know why, it's pretty clear in the law. What about beneficiaries? People who inherited IRAs or Roth IRAs, non-spouse beneficiaries mainly, right. They have required minimum distributions. Those are also waived. Okay. Another question is, if it's waived, does that mean, and I don't know where people got this one, if it's waived for this year, do they have to double up next year? No, this year just didn't happen. Make believe it didn't happen. You take a year off and you pick up where you left off. So those are some of the biggest questions.
Well, the one I'm getting from people is, gosh, I took mine at the beginning of the year before this new regulation came out. What do I do? How do I recontribute this? Can I recontribute it? So talk to our viewers momentarily about that, please.
All right, this is buyer's remorse. They were ahead of the pack. They took their RMD maybe in January or February, and then all of a sudden the law gets signed March 27th, and they say, I want my money back. I want a do-over. I want to return it to the IRA. That's called a rollover. Can you roll it over? Yes, if it's done within 60 days of receipt. But the government, the Treasury actually, just expanded that 60-day window, but it's a quirky fix. And I wouldn't worry if you don't fit into this, because I think they'll clean this up. But right now, if you took a distribution, your RMD, between February 1st and May 15th, you now have until July 15th to put it back, and to make things more complicated, unless you violated the so-called once per year IRA rollover rule. So if you did a rollover from one IRA to another in the past 12 months, then you don't qualify. If you took your RMD in January, then you're out. You can't put it back. So I would relax. If you don't fall into that window where you can put it back, don't worry about it. I think IRS will come up with some blanket relief. Why do I think that? I don't have any inside information except history. They did that back in 2009 when RMDs were waived for 2009. They gave blanket relief to many people. So I think they'll come back. They just have bigger fish to fry, bigger things on their plate now.
Of course, something that's new this time is the ability to borrow against an IRA, which nobody's ever done. So I know, Jeff, I want to give it to you because I know you've got some questions for Ed that I know our viewers are going to want to hear the answers to on the ability to borrow against their IRAs.
Yeah. Hey, Ed, Jeff here. You know, there's lots of confusion out there. You pointed out a lot of things, and we could probably spend a whole show talking about the confusion. But let's talk about the CARES Act and how it benefits the consumer. Give me the top 2 benefits from your perspective on what the CARES Act does. Is it the Roth conversion? Is it the suspension of RMDs? What's the benefit to consumers here?
The suspension of RMDs, but you hit on a good point. First of all, I just want to correct the terminology. You can never, ever borrow from an IRA. That's a prohibited transaction. So when people use that term, it means they take the money out and they have a little more time to put it back. But you're not supposed to use the word borrow because it's prohibited. So the big item is the RMD waiver, but you hit on even a bigger point. Some people are saying, oh, great, I get a year off. I don't have to take anything. But maybe you want to. Maybe this is a prime opportunity to do a Roth conversion you couldn't do before. Remember, RMDs could never be converted to a Roth. You just had to take the money out and pay the tax. Now that there's no RMDs, you have a perfect storm of opportunity. You have low values and low tax rates, and now you can take what would have been your RMD and convert it, or you could take any amount. Doesn't have to be, you have total control. You should look at the tax brackets and take advantage if it suits your income bracket and take some of that money and convert it to a Roth. There's benefits there. You're moving it to tax-free territory. The more money you move to a Roth, once it's in the Roth, there are no RMDs, so it will lower your future RMD tax liability going forward.
Mm-hmm. And correct me if I'm wrong. Correct me if I'm wrong, Ed. But we had 45 seconds left. But if you, that much I know. But and now we have 40 seconds left. But correct me if I'm wrong. But the part about being able to pay it back within 3 years, the question becomes, well, if you don't pay it back in 3 years.
Oh, you're talking about a different provision. You're talking about something called CRDs, coronavirus-related distributions, where you could take up to $100,000 out of your IRA or plan, but only if you're an affected person, which comes in 2 categories. You're affected with the disease, or your spouse or dependents are, or you have adverse financial consequences, layoff, furloughs, all kinds of terrible things happen. So if you qualify as an affected person, yes, you could take it out. If you take it out, you have 3 years, the tax is spread over 3 years, but you could pay it back. Maybe that's what you meant by borrowing it, but you're not really borrowing. The intent of the law is to use it because you needed the money.
That's right. That's right. That's exactly what I meant when I said borrow. It's kind of what all the articles are written. They're talking about loans and so on. So anyways, Ed, we need to leave it there for now. Thanks so much for being back with us on the show. We really appreciate you being here.
Visit theRetirementIncomeStore.com today to find out how you can rescue your retirement.
There's one more provision in the CARES Act that's worth mentioning, and it has to do with student loans. Now, that may not seem like a big retirement planning issue, but for many it is. According to AARP, people age 50 and over are on the hook for roughly 20% of the nation's student loans. Also, since 2004, student loan debt for people age 60 and over has grown faster than for any other age group. In the wake of the financial crisis, many older Americans went back to school to learn new job skills, and this was only 12 years ago, and they took out loans in the process. Others have taken on student loan debt on behalf of their children or grandchildren. And since paying off debt is an important part of a successful retirement strategy, yes, student loans are a potential obstacle to success for many people. In recognition of this, the CARES Act included some relief for student loan borrowers during the coronavirus crisis. Specifically, under the new law, no payments are required on federal student loans owned by the U.S. Department of Education between March 13th and September 30th of this year. In addition, the interest on these federal student loans will automatically drop to 0% for the same time period. However, private student loans and federal loans that are not owned by the Education Department are not covered by the CARES Act. You don't have to take any action to capitalize on the new law, and if you already made a payment after March 13th, you can contact your loan servicer and get a refund. As the coronavirus pandemic wears on, more federal relief programs will likely be needed to deal with the mounting economic damage. As I'm sure you know, another $484 billion relief bill was signed into law by President Trump just very recently. That one was designed mainly to provide additional help for small businesses and hospitals. But before this crisis is over, more changes may be in store at the federal level that could directly impact your retirement plan. So as you stay safe, it's important to also stay informed and to discuss these potential impacts with the right financial advisor. Now it's time to bring in our co-host, Jeff Small. So Jeff, you just heard and talked to Ed Slott. He had lots to say. Tell myself and our Income Generation viewers and listeners what you think are the most salient points from Ed Slott.
Well, I think the coolest thing for the Income Generation viewers and listeners to take advantage of under the CARES Act, which we discussed with Ed, is since they don't have to take out required minimum distributions, this is the first time in history of the tax code that you can take your required minimum distribution and convert it into a Roth IRA. Actually, you could pull out more and convert. But now there's never been a better time to convert a portion of your asset. Instead of creating a taxable asset in your IRA, create a tax-free asset in your Roth. And that's what everybody should be doing today, especially the folks, Dave, who don't need their RMDs to live on. If you don't need your RMDs to live on, you've got to convert that into a Roth.
Yeah, I mean, today, a married couple filing jointly could be in the 15% bracket, 12% bracket actually, all the way up to 100,000 or so of income. So if they're used to taking their required minimum distributions, even though you don't have to take it this year, take it anyway. Technically, it's not called an RMD, and that's why you can do a Roth conversion. But you know, I was alluding to this back at the beginning of our show, Jeff, before we interviewed Ed, and that was the fact that to me, what I like to do with Roth conversions, and we did a lot of this back in 2008 during the financial crisis, is to take the part of your portfolio that's gotten beaten up the most and to convert that part of it. Because what I want you to know as our viewers and listeners is that you can convert any part of an IRA. So if you have part of an IRA with certain holdings that have really beaten down, maybe you have some oil stocks that have really beaten down, they could be down 70, 80%. It might be a great time to say, let's convert those to a Roth IRA, because now you're paying taxes on 20, 30 cents on a dollar, and when they eventually recover, all that pop, if you will, comes back in a tax-free Roth IRA account. And Jeff, that was exactly what I was alluding to earlier on in the show before we interviewed Ed, that we really didn't have time to take advantage of that in March because the market raced to the bottom so fast and then raced back up. I mean, heck, you know, being up 3,000 points on the Dow, more than 3,000 points through the month of April, and that's huge. You know, if you didn't react really quickly, you couldn't have done what I just said, correct?
You couldn't have. You didn't have the time. But your points, Dave, about converting depreciated assets into a Roth conversion and paying less tax than you would have before the correction that we had is phenomenal. It's what everybody should be doing with a portion of their IRA, especially if they look at assets that are still below the high water marks, because we know a lot of sectors still are.
Yeah, and you know, for viewers and listeners, you know, don't always expect your advisor to think of this stuff, because you have to realize too, sometimes when the market's going down, it's down significantly. You know, he's on the phone with all of his clients. He's on the phone with you. He's doing damage control. He's given the speech that Jeff and I always talk about, right? Hang in there. The market comes back. Don't panic. And it may drop further before it comes back. It may not. You never know. But the point is that he's not thinking about being proactive and taking advantage of this opportunity. And Jeff, that's why I want to focus on the positives here, because I think there's lots of ways that our viewers and listeners could take advantage of it. One is the Roth conversions. But also, I believe that all this headline news now, not about the economy, headline news about the economy is really bad, but headline news about the virus itself is pretty positive, and that's what's causing the market to go up. So the market seems to be decoupled from the economic news and more tied to the virus news, which it shouldn't be. So I believe that when the market finally realizes that we're in this for a longer period, there is going to be another shoe to drop in the market. Whether we break through the lows from March or we just test them, I don't know. But I think at that point, things should stay at a lower value longer. And that gives opportunities. That might give people opportunities then to actually do these Roth conversions with the depreciated assets, because it doesn't just, dead cat bounce off the bottom. But I mean, you and I have talked about other opportunities too that occur with that, correct?
Yeah, that's something that folks definitely want to take advantage of. It's not all doom and gloom. If asset prices drop, Dave, when we go back to retest the lows, that's just another opportunity for them to convert a portion of their IRA assets at a discount. There's nothing wrong with that. But you're right, we are headline driven. And what's driven the markets this week is the fact that the vaccine trial, remdesivir, had a good result in its third reporting. Had a good result on its first reporting, a terrible result on its second, and now a good report all of a sudden, how it's shortening the virus, and the markets like hearing that kind of stuff. Even though Gilead's stock didn't really move, it was flat, but the markets still like positive news on the virus.
Yeah, and I get concerned because the market is almost acting with the same joy that the medical field should be acting, but not realizing that that still means that a lot of things are going to change for a long period of time, where parts of the economy are going to take a long time to get started. Some people may not go back ever to the same stuff they did before, and those are things that have to cause another shoe to drop. So I'm looking at it right now as a great opportunity for you, our viewers, our listeners, members of the income generation who are retired or within 10 years of retirement, to look at this as an opportunity to take some of your winnings off the table. If you got caught, so to speak, with your pants down on the last drop in the month of March, and you saw your net worth go down by about 40% and boomerang at least 2/3 of the way back up, that's great, because now it might be a good time for you to act and get ahead of it. Don't bury your head in the sand. Don't panic. And Jeff, what I want to do right after this commercial break in the next segment is I want to brainstorm with you, for the benefit of our viewers and our listeners, of some of the things that you and I both really think they can do right now to take advantage of the market and where the market is, really to look at this as glass half full, not necessarily glass half empty. So stay with us. We have more coming up, a lot more coming up, right here on The Income Generation in just a moment. We'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
With governments around the world taking action to combat the economic impacts of the coronavirus pandemic more and more each day, things have calmed down a bit in the financial markets. As of this taping, the Dow Jones Industrial Average has gained back more than 3,000 points from the beginning of April and is really down only about 17% on the year, though it's still down about 23% from its peak high in February. However, in recent weeks, the wild swings and the steep drops that we saw throughout March have eased considerably. That's partly due to efforts like the CARES Act and other relief efforts, as well as the extreme actions taken by the Federal Reserve, as well as other central banks around the world in response to the crisis. It's also due to increasing optimism that the infection curve for COVID-19 is flattening, with some states getting serious about at least partially reopening their economy soon. And of course, that's all great news. But if you've been watching our show recently, you know that I'm not nearly as optimistic as some analysts that the recent calmness is a true indicator that the worst is over for the stock market. I think it's a temporary calm and that we still have another shoe to drop. Some market watchers are already debating whether we'll have a V-shaped recovery, where the market dips and climbs right back to its previous peak in a relatively short period, or a U-shaped recovery where it lingers at a low point for a while before eventually regaining its peak. What no one is talking about is a W-shaped recovery, which I believe is more likely. The market has already taken a steep drop and partially recovered, creating essentially the first half of the W. Now, what happens if we get another spike in infections, or what if states run out of money to pay unemployment benefits? What about if hundreds or more businesses actually go under as a result of this? The point is, any number of things could trigger the next major downturn needed to complete that W. Unfortunately, I see that as a much more likely possibility compared to a V-shaped recovery or a U-shaped recovery. But here's the good news. Right now, you still have time to take some money off the table and reduce your market risk. And a good way to start, of course, as always, is speaking with a financial advisor who specializes in asset protection and retirement income. Now it's time to welcome back Jeff Small. So Jeff, you know, you had a little more time than me. We had a quick commercial break, and then I had to do that monologue portion of our show. So you had a little more time to think about the things you think that our viewers and listeners should be considering, maybe not necessarily acting on right away, but considering to turn the negative into a positive, to take advantage of at a time like this. Tell us your thoughts.
Sure. Wow, Dave, so many great things. But one of the most important things circumvents around the topic of our show today, which really the core of it was IRAs, EdSlot, RMDs, what do we do going forward? And so most listeners, our watchers, don't understand that 40% of the S&P's return since 1929 has been dividends. If we're used to pulling money out of our IRAs, and so many companies are suspending their dividends, we're not going to be able to reproduce the income that we're going to actually pull out from our IRAs. We're going to be eating into the principal value and be dependent on market appreciation as we go through this corona roller coaster on the markets. And so at this point in time, now is a great time to take a look at how do we get our IRAs to create income and get off of the markets supporting that income, because the dividends have been cut dramatically, Dave. Across the board, 2/3 of all companies have reduced their dividends or gotten rid of them, suspended. Just like they did in 2003 and 2008, they did it again in 2020.
Well, I mean, there's two things. Number one, they're really decreasing dividends because they're trying to hoard cash, which is a smart thing. You own stock in a company, you'd want them to do that. But what they're also doing is discontinuing share buybacks. So share buybacks, as you've always said, is one of the things that's really supported the market over the last 4 or 5 years more than anything else. So that doesn't bode well for common stocks on the yield side. It also doesn't bode well for common stocks or stock mutual funds on the growth side either, right?
No, it doesn't. It puts a hurting on what the appreciation potential is going to be over the long term or short term of, let's say, 3 to 5 years. We don't see a lot of upside to the market as we unwind through this kind of stuff. So now's a perfect time for investors, watchers, listeners to say, look, if I'm taking money out from my IRA to live on, and it's in the markets, I need to modernize my portfolio to reflect what's going to happen and actually use my portfolio to create income, as opposed to losing the dividends, losing the buyback potential of accelerating appreciation, and then dealing with all the economic issues we've got coming into the future. Or we could be eating into the values of it, eating into our principal.
Yeah. And what I want to do is, in a minute or so, we've got to take a commercial break. We come back from that break. What I want to do is I want to focus on the things that you can do to generate more income, to generate more yield. But you know what I'd like to do? Tell me if you'd like to do this, Jeff, or not. We've been talking about the news and kind of talking about a negative tone with the markets now for a long time. And, I can't help but think that we need to do a show next week just on the positives, all the positives and doors that have gotten opened up from this coronavirus crisis. Think that'd be a good idea?
I think that'd be a great idea, Dave.
It's a date. Next week. Let's do it. You and I think it's a great idea. We should do it. And you stay with us. We'll be right back with more on the income generation. Again, talking about some of the positives and opportunities you can take advantage of this week. We'll be right back. Welcome back to The Income Generation. I'm David Scranton, and we're here with co-host Jeff Small. So Jeff, we talked just before the break about next week's show, which we never let our viewers or listeners really get a peek under the hood as to what we have up our sleeve for the next week. We probably should. But this is, I think this is a great idea. I think we should have a show next week to talk about the financial opportunities, but also some of the opportunities that, new hobbies, new things that people have gotten in their lives, and some of the soft stuff too, because there's a lot of positives that have become of this. And I think, we really need to do a show and focus on those positives, because they're things that don't have to end when the coronavirus ends, when we get a vaccine, correct?
Well, sure, absolutely. I mean, we've had to think outside the box here and get creative on all this stuff, and I would love to talk about that and the themes and everything that we have discovered, Dave, on that kind of information. People need to have that today.
So share your thoughts, if you will, with our viewers and our listeners about the types of things they should be considering when it comes to increasing that income, increasing that yield inside their IRAs.
Well, if you Google fixed income, because that's one style of investing, it'll say income that doesn't change or income that's fixed and level. And so there's a whole plethora of investments that you can access that are interest earnings based. They generate dividends and or yields. And so that's where we go to create income. And that's the shift from an accumulation mindset to a conservation and income mindset, meaning we don't want to lose our principal, but we want to create that income, especially now with the dividends being cut so drastically and suspended for the majority of the S&P 500 companies and the various Dow components. We need to look for income, so we need to become more income centric.
So you're saying basically making the transition, as you and I always say, from the G to the I, from a growth-based philosophy to an income, interest and dividend-based philosophy. But also, one of the benefits of that is that a lot of these instruments in this universe that you're describing have to do with investing by contract, where you have literally a contract, just as if you would if you owned a real estate and had a long-term lease with a credit-worthy tenant. You wouldn't care if the value of the real estate went up or down. At the end of the day, all you cared about was you have this great, solid, long-term lease, and you're going to get your rent check, your income, every single month. Much like that example, right?
Well, there's no doubt. So if I bought a rental property that was paying me 5% net for $100,000 and it was generating $5,000 a year of income, do I care if that rental property's valuation in 12 months drops to $95,000?
Nope.
Only if I sell it do I care.
Right. And you also don't care if it goes up either, because it doesn't matter. Your income stays the same, right?
Well, that's right. If it goes up to $105,000 and I paid $100 for it, if I'm still getting that $5,000, well, then I got to replace the rents. So I don't really care about the valuation. I care about the income.
Absolutely, absolutely. Jeff, we need to take another break. Thanks so much for being back on the show and helping me out. I appreciate it. Look forward to next week. Next week's show is going to be a lot of fun. And I'm looking forward to seeing you next week also. But don't go anywhere. We have more coming up on this episode right after the break. We'll be right back. I'd like to thank our guest today for joining us for another episode of The Income Generation, but of course I'd also like to thank you, our new and returning viewers. As the crisis wears on, I hope all of you are faring well and doing what you need to do to stay safe, to stay healthy, and optimistic about the future as you possibly can. Now, that can be challenging in the midst of so much pessimistic news and without access to many of the things and activities that typically help us become happier individuals. Spending time with friends and family, going out to eat or to a movie or to a baseball game, traveling, or just going shopping without having to wear a face mask and gloves. These are definitely difficult times, and what makes it harder is that there is so much about the situation that we simply can't control. And that's why it's important, wherever possible, to focus on the things that you're grateful for and the things over which you do have control. For example, you can take advantage of modern technology to stay connected with friends and loved ones. It's not the same as seeing them in person, but it helps. You can choose to stay active and productive at home, to keep mentally stimulated and physically active. And finally, you can choose to stay informed, to understand the opportunities available to protect your financial future, and to modernize your retirement plan for the new corona economy. Again, the right financial advisor can help you identify and take advantage of these opportunities, and there's never been a better time to take action. Thank you for watching. If you're close to retirement and you really want to know how to protect and maximize your money, then it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.